Chinese sanctions and their impact on the US dollar. The global financial system is undergoing a significant transformation, with China actively countering US economic dominance through sanctions, trade policies, and financial restructuring. The US dollar, USD, has long served as the world's primary reserve currency, facilitating international trade, investment, and financial transactions. However, China's recent actions, including economic sanctions, resource restrictions, and the promotion of the yuan (CNY) in global trade, are challenging the dollar's supremacy. This article explores how China's financial and trade policies, particularly in response to US sanctions and economic pressure, are accelerating the shift away from the dollar and reshaping global economic power structures. China's countermeasures against US sanctions. China has been on the receiving end of US economic sanctions, particularly in technology, finance, and defense sectors. In response, Beijing has implemented countermeasures that directly impact the US economy and undermine the dollar's influence. One of the most strategic areas where China has retaliated is its dominance in rare earth metals. These elements are crucial for high-tech industries, including semiconductors, electric vehicles, and military applications. By restricting exports of these critical materials, China has disrupted US supply chains, increasing production costs for American manufacturers, forced companies to explore alternative sources, accelerating global efforts to reduce dependence on China, created leverage in trade negotiations by using its control over these resources as a bargaining tool. For instance, in 2023, China imposed export controls on gallium and germanium, two key elements in semiconductor production, causing price surges and supply concerns for Western manufacturers. These restrictions significantly impacted global tech supply chains and forced companies to rethink their sourcing strategies. Beyond resource restrictions, China has also targeted American businesses and financial institutions through regulatory crackdowns and restrictions. These measures include fines and penalties against U.S. companies operating in China, increased scrutiny of American firms, particularly in finance, consulting, and technology, restrictions on investment outflows, limiting American firms' access to the Chinese market. Notably, Beijing has restricted Chinese banks and companies from engaging with U.S. financial institutions that enforce sanctions against Chinese entities. This move reduces global demand for the dollar and encourages the use of alternative financial systems. China's push for the yuan in global trade. One of the most profound challenges to the US dollar is China's effort to promote the yuan in global trade and finance. By encouraging trade partners to use the yuan instead of the dollar, China is actively reducing global dependence on the US financial system. For decades, the US dollar has dominated oil trading, a system known as the petrodollar. However, China has actively negotiated oil trade deals in yuan, leading to the rise of the petro-yuan. Key developments include Saudi Arabia, Russia, and Iran have all agreed to accept yuan for oil transactions, reducing demand for US dollars in global energy markets. The Shanghai International Energy Exchange (INE) allows oil contracts to be settled in yuan, providing an alternative to US-controlled financial markets. BRICS nations, Brazil, Russia, India, China, and South Africa, are increasingly supporting local currency trade, further challenging dollar hegemony. These developments indicate a clear shift in the global energy trade landscape, reducing the dollar's central role and weakening its influence over international markets. China's alternative financial systems. China has taken significant steps to build financial infrastructure independent of US-controlled systems. One of the most critical initiatives is the Cross-Border Interbank Payment System, CIPS, which serves as an alternative to SWIFT, the dominant international payment system controlled by Western financial institutions. CIPS facilitates cross-border transactions in yuan, reducing reliance on the US dollar for international trade. As more countries face US sanctions, they have turned to China's financial system to bypass restrictions. Russia has integrated its financial system with CIPS, allowing Russian banks to conduct transactions without using the dollar. Additionally, China has expanded bilateral currency swap agreements with over 40 countries, enabling direct trade in yuan instead of using dollars as an intermediary. Countries such as Brazil, Argentina, Indonesia, Turkey, and Pakistan now settle trade with China in local currencies. BRICS is also exploring the creation of a common currency, which could further reduce dollar dependence in emerging markets. The yuan is now among the top 5 global payment currencies, surpassing several Western currencies in international trade volume. De-dollarization in action. China's de-dollarization efforts are already reshaping global markets, leading to significant consequences for the U.S. economy and financial system. One major shift is China's gradual divestment from U.S. Treasury bonds. Historically, China has been one of the largest holders of U.S. debt, but Beijing has steadily reduced its holdings, signaling a shift away from the dollar. China's U.S. Treasury holdings have dropped from over $1.3 trillion in 2013 to around $800 billion in 2024. Lower demand for U.S. debt could lead to higher interest rates and increased borrowing costs for the U.S. government. If more countries follow China's lead, the U.S. could face a potential debt crisis, forcing policymakers to reconsider economic strategies. A weaker global demand for the dollar could also contribute to higher inflation in the U.S. Less foreign demand for U.S. assets means a weaker dollar, making imports more expensive. Increased reliance on domestic production could drive up costs for consumers, and global commodities like oil and metals priced in other currencies could lead to dollar devaluation. Global reactions and future impact. As China continues to expand its influence in international trade and finance, the global economic order is shifting toward a multipolar system where multiple currencies, including the yuan, euro, and rupee, play a significant role. Developing nations are increasingly turning to China as a financial alternative to Western institutions. The IMF and World Bank are losing influence as BRICS and other regional financial institutions gain traction. China's economic alliances with nations like Russia, Iran, and the Gulf states are creating a new economic bloc that bypasses the dollar-based financial system. While the US dollar remains the world's dominant reserve currency, its grip on global finance is gradually weakening due to China's strategic policies. The combination of trade and financial retaliation against U.S. sanctions, the promotion of the yuan in global trade, the development of alternative financial institutions, and the decline of U.S. Treasury bond holdings all point to a gradual erosion of the dollar's supremacy. However, despite these challenges, the dollar still holds significant advantages, including liquidity, trust, and its entrenched role in global finance. The real question is not whether the dollar will collapse but whether the world is transitioning to a multipolar financial system where multiple currencies share dominance. China's long-term strategy suggests that the answer is yes, and the US will need to adapt to this new financial reality.